We're looking for much sharper increases in silver prices late this year into 2025, possibly into 2026. The correlation between gold and real gold price changes and changes in interest rates is zero. We have any number of investors who will sell at $50 silver. We don't necessarily advise people keep 25% of their wealth in gold, except in extremely hostile economic and political environments, like now. So what we've been saying is that the treasury market's going to be the last thing to collapse. We're looking for record prices, further record prices in gold late this year into 2025. Silver use in solar panels is much more real than either platinum use in electrolyzers or lithium in batteries. If you look at gold versus cryptos, the people who are investing in cryptos are the kinds of guys who go to casinos.
Jeffrey Christian, Managing Director of the CPM Group and a veteran pundit in the precious metal space. Could you briefly introduce yourself and explain how you ended up becoming a guru of the gold bug world?
I studied journalism and international politics in university in the 70s. And in the politics side, I was very interested in journalism. I was interested in business journalism, and the political science side, I was interested in international economics, specifically how developing countries trade it and how communist countries trade it. And a lot of that trade was and still is commodities oriented. So I did a lot of work on oil and gas and gold in South Africa and gold in Ghana in university. After school, I became a business journalist, and I was writing about energy markets, energy technologies. I wrote a book in the 70s on electric vehicles and metals, copper, other metals, uranium, and precious metals. In 1978, 79, the company I was working for, no one wanted to cover gold or silver. They thought they were dead metals. So I picked up that agenda too, and I was covering those. After a few years of writing about metals as a journalist, I went to a company called J. Aron. It was a commodities trading company. Back then, in the 70s, commodities trading was mostly boutique partnerships, private partnerships. J. Aron was one of the 12 largest precious metals trading companies in the world. They had a research department that produced fundamental research on gold and silver. I had been doing some platinum group metals research, and I added that to the portfolio and took over their research operation, basically producing estimates, the basic statistics that most other people used on supply and demand, investment demand, and inventories, gold, silver, platinum group metals. Aron was bought by Goldman in 81. In 1986, for a variety of reasons, I managed to a leveraged buyout of the commodities research department at Goldman Sachs that I was running and set up CPM Group as an independent commodities research consulting company. And I've been doing it under the purview of CPM Group since 1986. It's a small pond. There are very few people who actually study these things. There are a lot of people with belief systems. We sometimes point out that we are both the highest cost and the lowest cost purveyor of precious metals research and consulting and statistics. We're the highest cost because we actually do the research, and we travel around the world, and we have contacts around the world to collect data from largely opaque and secretive markets, refiners, industrial users, investors, as well as producers. But we're also the lowest cost because we do that and we have this database. If someone comes to us and says, I need to know about a specific area, gold, silver, platinum, or specialty metals that we do, like manganese and molybdenum and tantalum and niobium and titanium, we have that data there, and we have the analysis, and we have the knowledge and expertise. So that's who we are in a nutshell. We're the people who actually know about the supply demand of basic commodities.
Jeff, you put up a video recently on the CPM Group YouTube channel where you looked at past gold price spikes. And from the end of the 1970s to the current day, you outlined 4 periods in which gold bugs did very well. And those were from 1979 to 1980, when inflation was at 14% in the US. Then again after the 1987 stock market crash, and now entering into my lifetime after the 2008 financial crisis, and then again in 2011 with the EU sovereign debt crisis. So those are 4 historical periods that you outlined. Could you walk us through what the lessons were from those case studies and what it all means for the gold price going forward currently at all-time highs around 2,300 per ounce?
What you see sometimes, and one of the points that we were making in that video was that you can have these big spikes up and then the price comes down. And there's this constant education program that we do to convince people or to discuss with them the difference between annual prices, which is what we project on a 10-year basis, and intraday prices. So, if you go back to 79, 80, as I said, at the beginning of 1979, gold was less than $300 an ounce, and no one wanted, gold was dead. It had risen from $35 to $68 to $300, and it had come back off. And it was probably around 190 actually at the beginning of 1979, and gold was dead. It had a one-time adjustment, people thought, and we picked up the portfolio, and what you saw was gold prices rose very sharply. That was an interesting period of time because you had 14% inflation, as you said, in the US. You had the dollar was actually rising. Paul Volcker took over the Fed in October of 79. He said, we have this rampant inflation, partly because the Fed has been targeting interest rates as opposed to inflation. So I'm going to target inflation. And he took interest rates from like 7% to 21%. That threw the world into a deep, what was that at the time, the deepest post-war recession. You also had Soviet troops invading Afghanistan, U.S. hostages in Iran, hostility between Iran and the United States, leading to a quadrupling of oil prices, gas lines, petroleum shortages in the developing countries. You had a lot of economic and political problems. And in that environment, there weren't a lot of it. We didn't have futures options. We didn't have stock futures. We didn't have stock future options. We didn't have currency options. So there were not a lot of ways to hedge your portfolio, your stocks, your bonds, your currencies, except for gold and silver. And that kind of environment, gold spiked up to $850 in early 1980. It came back down $146 the next day. And it basically came down and it averaged, I think, around $612 for the year. That was at the beginning of a recession. You had a lot of investors who felt wealthy. The stock market had been doing well. Bond prices, the yields on bonds had gone up. And there were wealthy people who were extremely worried about their wealth going forward because of 21% interest rates, heading toward a recession, quadrupling of oil prices. This could be ugly. So there was a lot of money coming out of stocks and bonds. And where was it going to go? It was going to go into gold and silver. And so you had that. And then once you got into the recession and once that portfolio diversification had happened, the gold price fell off. It didn't go back to $200 or $300 initially. It did ultimately like 20 years later, but it did come off. So that was one of the things that we noticed. In the stock market collapse of 87, the Fed said that is a stock market event, not an economic event. We agreed. We didn't think there'd be a recession until 1991. There wasn't. Gold had gone from $286 in early 1985 to $500 in the fourth quarter of 87. We said sell. And the price did, in fact, come down to about $400 within 3 or 4 months of that sell signal. And then in 2008, 2011, it was a different change. We wrote a report in late 2000 where we said there is going to be a renaissance of gold as an investment asset and a portfolio diversifier and a monetary reserve asset. It will start with private investors, and you will see an upward shift in the investment demand curve for gold. More investors in more parts of the world will buy more gold for a longer period of time at higher prices than ever before. And that, in fact, happened. And then we said also later on, central banks will join in that accumulation program. And that started around 2008. You saw a shift from central bank being net sellers to central banks being net buyers of gold. So you've seen this upward shift in the investment demand curve starting in 2000, 2002, and that changed everything. So that 2008, 2011 were radically different. And in some ways, they're similar to where we are now, which is that you have a tremendous amount of money out there, and you have a lot of investors who are extremely concerned. Hey, things look good right now. I've been worried about a recession that hasn't emerged for 3 years. Maybe it's not going to emerge, but I don't think I want to let my guard down. So what you're seeing right now is a lot of investors with a lot of record U.S. equity prices. I need to diversify my portfolio. I need to capitalize some of my gains in stocks and corporate bonds. I need to protect myself against what could be a more hostile economic and political environment going forward over the next several years.
I suppose the main takeaway is just what we already knew, that gold's price momentum sort of depends on the world going to hell in a handbasket, or at least people fearing that might happen. But if history shows us that gold gives protection against black swan events, does that mean that ideally you want to keep it as a fixed proportion of your portfolio? And so given gold has been rallying lately, would you therefore suggest that investors start trimming their gold exposure to get back to that sort of target weight?
Well, it depends on the individual investor, but we think that gold always has a role as a portfolio diversifier, as a wealth diversifier, as a hedge against inflation, a hedge against currency market volatility, as a safe haven type of place, and as a commodity. And we're all, our advice is that you should always own some gold, and you should own some physical gold as a insurance against catastrophic problems, either your own or globally or locally. But you can also have other portions of your wealth in more trading oriented and opportunistic gold assets, including physical gold, but futures, options, ETFs, mining shares, and things like that. And you can have some longer term investments, and you can have some shorter term investments too. The proportion of your wealth should shift over time given where we are in an economic environment. We've done a lot of work on the efficient horizon, like since 1968 when gold prices were freed. What was the optimal percentage of your wealth that should have been in gold? And it's like very high. It's like 25% or so. We don't necessarily advise people keep 25% of their wealth in gold, except in extremely hostile economic and political environments, like now. Other times we might say 5% or 10%. And I think you have to pay attention to the economic environment around you, and you have to have a realistic and sober, fact-based view of where you are economically and politically. You can't either have these rose-colored glasses where everything's going to be fine. The government will take care of the stock market or whatever. I don't have to worry. And you can't have this cataclysmic belief system that everything's going to decline. And you probably interview a lot of people who they see the world in black or white, right? And the treasury market's going to collapse, the dollar's going to collapse, Russians are going to come out with a gold-backed currency, and gold's going to $15,000. And those are belief systems. They're not based on economic realities or anything that you would consider reasonably possible scenario, economic or political scenario. And you have to avoid those. And then, there are times when you want to lighten up your gold, and there are times when you increase your gold positions.
I'm interested to hear more about how you arrived at the conclusion that 25% could be an optimal allocation towards gold. Because,
yeah,
I mean, I imagined that if you'd invested in the S&P 500 over the last 30, 40 years, 100%, you would have done a lot better than if you had any gold in your portfolio, no?
What we did is, it's like Ibbotson and Associates did this in the early 1980s. And it's a standard portfolio analysis. You start with a portfolio with some proportion in the S&P 500 and some proportion in treasury bills or treasury bonds. And we start with 50-50. Some people start with 60-40, some people start with 40-60. Some people have all kinds of convoluted things that they've developed themselves that they work on. But, Ibbotson said, let's start with 50-50 and let's just go forward. And you take 5% and you put it into gold, and you look at the monthly changes in prices for gold, stocks, and bonds. And on a rolling basis, you go forward. And using that, and then you say 5%, what does my portfolio's risk reward profile look like? And when you add 5% of your portfolio into gold, it reduces the risk of the overall portfolio volatility and actually increases the return on a rolling basis from 1968 until the present. You add another 5%, you put 10% of your portfolio in gold, and the risk goes down further and the return rises. And you keep adding 5% and you get this horizon, which is a parabolic curve. And there's a place where all of a sudden the risk starts rising faster than the returns, or the risk actually, the percentage of volatility, the risk is greater than the return. Historically, it's all historical, and past performance has nothing to say about future performance. But you create that parabolic curve, and the place where the maximum risk reward ratio, the optimal risk reward ratio is around the 25%, 25-30% mark for gold.
I want to move the conversation towards inflation and interest rates, because often we hear that gold prices go up when real interest rates fall. And that's right, because the opportunity cost of holding our pet rocks is the interest that we could be earning on bonds or in money market funds, for example. And this all sounds perfectly logical. But is that theory holding up in the current environment? Because interest rates have been rising and inflation has been falling. So real interest rates are increasingly positive, and yet gold keeps hitting new all-time highs. So isn't this the opposite of what you would have imagined would happen?
Let me just, before I answer that, let me just add one thing to what I had just said. That procedure that we use in creating that parabolic curve, the optimal allocation to gold, is purely mathematic and mechanical. There's no theory there. It's very important in my mind that you try to invest on empirical evidence and not theories, because I don't have great faith in theories. Now, gold versus interest rates, gold versus inflation. The correlation between gold and inflation since 1968, monthly changes in real gold prices versus monthly changes in inflation, about 9%. So inflation is a factor there, but on aggregate, it's not very good. The correlation between gold and real gold price changes and changes in interest rates is zero over time. But you can disaggregate it. Let's start with interest rates. You disaggregate it and you say what happens, and you get this beautiful scatter plot of changes in gold prices and changes in interest rates. And what you find is that the correlation of changes is about negative 16%. and it's pretty well equally divided. And then you start saying, well, what, if I want to look at those places where interest rates are rising and gold prices are falling, what's the environment, the interest rate environment? And it's generally speaking when interest rates are rising and the real interest rate is greater than 3%, which has actually been pretty rare. And we've had negative real interest rates for the better part now of 14 years. So you can have a sharp increase in interest rates from 0 to 5%. But if your inflation is running around 4%, you have a positive interest rate, real interest rate of 1%. And most investors are not going to say, oh, I can lock in 1% over the next 10 years. Why do I need gold? If you see interest rates, let's say that inflation stays at 3.8. Let's make it easy. Inflation goes to 3%. It's not there now. Core is 3.2. Headline is 3.8. Let's say 4%. Let's say that inflation stays at 4%. I need 3% real interest rates before investors start abandoning gold, saying, why do I need gold? I can get 3%. I can lock in 3% for 10 years, which actually sounds pretty pathetic, but that's beside the point. That's 7% nominal interest rates. I don't know anybody in mainstream economics or monetary policy that is talking about 7% nominal interest rates in the foreseeable future, in the next several years. It could happen because I think we're entering a new era for interest rate policies and practices, but that's a high bar. And then again, that's only 3% real return. You have a lot of investors say, no, I want 5% real return or higher. So what you see is that you can say, yes, higher interest rates are negative for gold, but then you have to say, comma, when real interest rates are greater than 3%. Okay. Because, a 5% increase from negative 5% or negative 4% real interest rates to 1% doesn't move the needle for a lot of investors. And so what you're seeing right now is that interest rates have risen very sharply. They are now at the bottom of what they were for most of the period of time from 1968 to 2008. So while interest rates have risen an incredible 5% on a nominal basis over the last 2 years, they are at as low as interest rates got in the bottom of their interest rate cycles for the previous 40 years. So you've got a big span to go before you would expect those real interest rates to get to a point where investors start saying, what do I need gold for? In the meantime, as I said, you're going into what we think is a third era of modern interest rate markets that monetary authorities, including the Fed, have said, this is sort of uncharted territory. And we are in uncharted territory. We don't know how this is all going to shake out. We're not normalizing back to that 68, 2008 level practice, but we've clearly moved away from the zero interest rate policies that went from 2008 to 2021. So we're in new territory, and that creates a great deal of uncertainty, and you're not quite sure how it's going to shake out. What's it going to do to the housing market and to the auto market? If you disaggregate those markets, those are two very interest rate sensitive parts of the economy. But if you look at them, the weakness that we've seen in housing and the weakness that we've seen in autos is partly due to rising interest rates, but it's also due to secular changes within the housing industry and the auto industry and the auto market. And those changes may be more dramatic in limiting housing purchases and auto purchases right now than the higher interest rates. It's hard to say, but that's one way to interpret the data. So there's a lot of uncertainty there, and that uncertainty, gold responds to inflation. You get inflation at 14%, you get inflation at 7%, get inflation at 9%. Investors start buying gold as an inflation hedge. You see the dollar start falling, which it hasn't done since 2010, I think. But if you saw the dollar start falling against other currencies, you might see people moving assets out of the dollar, out of treasuries into gold. Right now, international holdings of U.S. treasuries are at a record $8 trillion. No one's dumping the dollar. No one's dumping the treasury. Those are relatively lower risk assets, as is gold. And one of the things that we've seen over the last 3.5 years or so is that investors have been trying to reduce their risk, including their exposure to financial markets and their counterparty risk with financial industry counterparts. So gold and treasuries and dollars actually make a tremendously attractive argument right now. And that's what you're seeing investors accumulate to. As the stock market rises, people say, let me take some profits, capitalize them. I'll park the money in gold and treasuries. Now, as the gold price rises, you have other investors coming in and say, I want to ride that gravy train higher. So you're seeing some short-term investment demand in ETFs and futures and options. You have a complex set of things. And then with inflation, again, it's like, if you look at the correlation between gold and inflation, it's like 7% inflation when investors start saying, okay, this is really problematic. That's changed a little bit, but by and large, that's what it's been historically.
Okay. So there is a relationship between the gold price and real interest rates and inflation, but it's a discontinuous one, is what you're saying. You have to get to 3% real interest rates before it starts to draw people out of gold and into interest-bearing assets. Okay.
Well, the other thing is you have to ask, why are interest rates rising, right? Yeah. If interest rates are rising because monetary authorities see inflation and they're jumping on it, and the markets perceive that the monetary authorities can control inflation, then it's negative for gold. But if interest rates are rising and the market's interpretation is that the monetary authorities cannot control inflation, then it's positive for gold.
Yeah. So it depends a lot on the context, not just on the numeric value. Yeah. I don't think you'll like this next question, because I suppose there's not really any way to empirically quantify it, but I'll ask it anyway. And that is, do you think that if Bitcoin and cryptocurrencies had never been invented, that the gold price could be much, much higher right now? Because as far as I see it, a lot of the demand for Bitcoin and Ethereum is similarly driven by distrust in traditional financial assets and institutions. It's that sort of same drive to take a portion of your wealth off grid. So to what extent do you think these cryptocurrencies are kind of eating gold's lunch?
I think the cryptocurrencies have had a very small effect of limiting the upward movement of gold and gold investment demand. And if you think about it, you have tens of millions, hundreds of millions of people buying gold around the world, believing in gold, and you have a very long history of gold as an alternative asset, a quasi-money, or a financial asset or monetary asset outright. Cryptos have been around basically a decade now. They really started to take off around 2014. And it's a very small market compared to the gold market. We think that a lot more money has been, if you want to say, how much money has been distracted from the gold market, we think a lot more has been distracted by the stock market than by cryptocurrencies. It's a much bigger market. It's a much more liquid market. It's a much more readily accepted market. You're talking about quadrillions of dollars of stock market equities and hundreds of trillions of dollars of actual outright stock equities. That's a big market, and it's done very well over the last couple of years, as well as over the last decade or two. And that's probably taken more money out of gold than cryptos. If you look at gold versus cryptos, the people who are investing in cryptos are the kinds of guys who go to casinos. And I say that from an informed perspective, a quantitative perspective. If you look at the volatility of returns in cryptocurrencies and you say, where do I find this kind of volatility? It's in a slot machine, right? The gold market going, it's like cryptos came along 2014, and let's look at gold since 2014. You've seen a steady increase in the amount of gold that investors hold, and a steady increase and significant increase in the value of that gold that's been held. Some variation, some downward moves, but basically upward. You look at cryptos at the same period of time, they went from virtually nothing to less than $1 trillion to $3 trillion to $800 billion to $2.5 trillion, all in the span of like 3 years. So the market cap, if you will, of those cryptos is much more volatile. It's not necessarily a portfolio diversifier or a safe haven. If you did that efficient horizon using Bitcoins, you would have a far different parabolic curve than you have with gold. So they're kind of like the antithesis of gold. And it's kind of a backwater. It's like, I think cryptos are similar in many ways to the internet stocks that blew up in 2001, or the collateralized mortgage obligations that blew up in 2007, 2008. I don't think that they're necessarily like gold, and it's a specialized place. There are believers or people who are frightened about the stability of mainstream currencies and mainstream financial markets that are dabbling in those things. But that's sort of like saying, I'm afraid of a fire, so I'm going to run into a burning building. I'm afraid of a fire. I'm going to get as far away from those burning buildings as possible, and that's gold.
Yeah. I mean, I don't say that cryptos are similar to gold in terms of
No.
price behavior, but what I'm saying is that there's a lot of overlap ideologically between those kinds of true believers in gold and true believers in Bitcoin.
Yeah, but it's bad logic if you think about it. Gold is a tangible asset. It's no one else's liability. You own it, and you can either hold it or you can store it in a trustworthy depository. Crypto and the value of gold is determined by the full faith and credit of gold, determined on a daily basis in the market by hundreds of millions of people buying and selling. The cryptos are totally intangible. They're created by somebody you don't know, who's assured you that they have limited credit, limited ability to increase the volume, but somewhere they've got the code that allows them to increase the volume outstanding, the same way that national central banks say, oh, we would never increase our money supply in an inappropriate fashion, but we'll do it in an inappropriate fashion, and we have the capacity to do it. So cryptocurrencies are sort of like the antithesis of gold, and they are far more risky than currencies. So you have somebody sitting there, you have two people sitting there, and they're watching the traffic, and they're saying, this is really dangerous. I need to protect myself from the volatility in the financial markets. One guy says, I need to do that. I'm going to buy gold, which is less volatile and more stable and tangible and nobody's liability, etc. The other guy says, I'm going to go the other way. I'm going to buy something that's totally spurious, that's created by an anonymous person that has had $3.8 billion of theft over the last year, that is totally untraceable. Oh yeah, that's the value of it. It's untraceable, right? When somebody takes it, who are you going to complain to? In the early days of crypto, there was a scandal about like $100 million or so lost in cryptocurrencies in Japan. And all these investors went down to the Ginza, and they were standing around on the Ginza wanting to protest the fact that they had lost all this money. Yeah, they couldn't go to the Bank of Japan because the Bank of Japan had nothing to do with it. So yeah, there are people who think that cryptos are the next big currency. And I do believe that central bank digital currencies will come, but I think that privately issued, anonymously issued cryptocurrencies will fade away. I used to say there'll be a big scandal, but there was a big scandal. They went from $3 trillion to $800 billion in 1 year. 2/3 of the value disappeared. Why? Well, because the full faith and credit of crypto markets just contracted, evaporated. People said, what am I doing? Oh my God, those drugs wore off. And I said, I've got nothing. I have nothing, and there's no one I can complain to about the fact that I've just lost 67% of the value of my quote investment. So there are people who say that cryptos are like gold, but there are people who say all sorts of things, belonging to various cults.
Mhm. Jeff, I understand that you're worried about the debt levels of governments globally, and that you see an eventual crisis on the horizon that could see a lot of investors pile into gold in search of a port in the financial storm. But then when you look at Japan, they've managed to rack up debt equal to 260% of their GDP. And yet they're still able to issue new bonds and roll over debt at very low interest rates. So if the bond vigilantes have still not come for Japan, is there any reason to think that the US, with its debt to GDP ratio at just 120%, is even close to running into trouble?
No, I think somebody has misrepresented me to you. I've been telling people that the U.S. Treasury market is the least risky debt market, right? And what you've seen, and I think I mentioned it earlier, you have seen a lot of money pour into the U.S. Treasury market, both domestically and internationally. Internationally held U.S. Treasuries are at a record $8 trillion. They rose 10.5% over the course of 2023. Investors are not dumping the treasuries. They're actually running to them because they're the least risky. And they're the least risky for a variety of reasons. And you touched on one, you have $34 trillion worth of debt. And yeah, that's a problem and it should be dealt with. But that's actually more of a symptom of the real problem, which is deficit spending. And that should be dealt with, but it hasn't been. I'm going to be doing a video for CPM Group later this week, in which I start off by saying, people are now saying, oh, the Federal Reserve Board chairman has said that the fiscal deficits and debt are unsustainable. I'm starting off with a quote of the Federal Reserve Board chairman saying the fiscal deficits and debt are unsustainable. That quote is from December 1987. Alan Greenspan, who had been the chairman for like 6 months, testifying on the Humphrey Hawkins testimony, December 1st, saying monetary policy is not the problem. It's fiscal policy. You have to get your deficit spending and your debt in order because this is unsustainable. You can't have deficits of $300 billion a year and debt of $8 trillion, up from $1 trillion 7 years earlier. Now, that was $7 trillion. Now we're $34 trillion. Does the size matter? Yes. Does the size as a percentage of US GDP matter? Yes. So 120%. But these are the US treasuries, which are considered less risky than virtually any other credit in the world. You have, on a global basis, something like $300 trillion worth of debt. It's representing more than 300% of global GDP. And almost all of it is it has a higher risk than treasuries. So what we've been saying is that the treasury market's going to be the last thing to collapse. And there's these guys, I'm sure you've interviewed some, that will tell you that the treasury market's going to collapse. There are people I've known since 1981 who have been assuring me for 43 years that the treasury market's about to collapse. And it hasn't collapsed yet. It will be the last credit market to collapse because it's the least risky. And what you're seeing right now is central banks and private sector people moving into treasuries, moving into the dollar. You look at foreign exchange reserves at central banks, they've been pretty stable 58 to 62% of foreign exchange reserves in the US dollar for the last 10, 20 years. There was a blip up when the euro came into being, and then it normalized back to around 60%. However, the euro holdings have gone from 29% of foreign exchange reserves to about 19%. People are getting out of the euro and staying in the dollar. So I think it's a problem. But US and Japan is a particularly, I mean, every country has its own idiosyncrasies, and Japan has this very insular financial system, keeping the money in there. And so that has been going on, well, really since the late 1980s, early 1990s. You had the lost decade, which turned into the lost 20 years, which has turned into the lost 30 years. But those are not the credit markets to be concerned about. The credit markets to be concerned about are the obscure corners of the private sector financial markets. CMOs. I spent so much time 2007 to 2010 explaining what a collateralized mortgage obligation was. And obviously the people at the Treasury had no idea, because they screwed millions or tens of millions of homeowners by not understanding what the CMOs were and how they worked. And it was really offensive the way they did that. It was offensive not to me, it was offensive to the world. The People's Bank of China said, hey, guys, you're really screwing over everybody except your friends at the major banks. Don't do that. It's going to be some obscure corner. And I actually referred to one that you would look for is the equity derivative market, because you have, as I said, more than $100 trillion of equities globally, the majority of which are US listed equities. But then you have quadrillions of dollars of equity derivatives written based on those. So you have a massive imbalance between equities and equity derivatives. And that could be the place where the debt market cracks, because the banks will say, oh, don't worry, because it all nets out. But it doesn't all net out simultaneously. And that's the problem. And that's why monetary authorities and regulators around the world have spent the last 15 years trying to get everything cleared through clearinghouses to protect against that kind of imbalance that caused the global financial crisis in 2008, 2011.
Let's turn our attention to silver. The metal has been trading at highs not seen since June 2021 in recent days, currently sitting at around $27. And as we all know, silver has much more of an industrial demand story than gold. But I'd say that a few people realize silver has an important military use in fighter planes and tanks and bullets, night vision goggles, bombs, missiles. And according to a report by the International Institute for Strategic Studies, a British think tank, there was a 9% increase in global defense spending for the year 2023. So my question to you is, do you think this ever-increasing global arms race could create any sort of boost in the demand for silver?
Yeah, first off, I think there are a lot of people who overestimate the military and strategic uses of silver. And governments and militaries around the world don't necessarily see silver as a strategic or a critical metal, partly because there's ample supplies and partly because it's not all that bad. Our estimate is that you might have about 50 million ounces of silver used in various military ordnance per year, about half of that in the United States. Because the U.S. budget, military budget, is larger than the 10 next large military budgets. We really spend it all. So the silver's there. It is used. It's relatively small. 10% increase means you're going from 50 million ounces to 55 million ounces. If that 10% increase were all in silver using armaments, but it's not. It's not in a lot of applications. And silver has, like, the US military has never really considered silver as a strategic metal. It did have about 137 million ounces in its strategic stockpile that it was told to accept from the U.S. Treasury when the Treasury got out of silver circulating coins in the late 70s. And there was, the Treasury had 3 trillion ounces of silver at its peak in the 40s. But as industrial use of silver rose and silverware and silver use in photography in the 40s, 50s, 60s, you started seeing upward pressure on the price of silver to the point where $1 per ounce silver, which was what silver certificates were valued at, or $1.29, which is where you could melt down silver-bearing U.S. coins and recover the silver illegally, profitably at $1.29. So you start seeing upward pressure on the price of silver. The Treasury said, we got to get out of the silver coinage business and the silver certificates. We have to pull back. And when they were done with all of that in 1967 or so, they had about 137 million ounces left, and they transferred it to the military. The military didn't want it. The military said, silver is not a strategic metal. We don't need it in the national defense stockpile, and we'd like to sell it. Congress blocked those sales from the late 60s into the mid 80s by saying if the military tries to sell that, they could damage the market price of silver, which would hurt Western silver mining interests. So the Congress said you can only sell that silver if you can assure us that you're not going to damage the market price of silver. The solution, which I proudly was part of creating, was to create the Silver Eagle and say we will use the strategic stockpile, and the Silver Eagle is only sold when investors want to buy it. So we're not distracting demand from other places. But if people want to buy these Silver Eagles, we'll use the strategic stockpile to make them. And when the strategic stockpile runs out, we'll buy silver in the market. And the strategic stockpile ran out of silver around 2000, 2001. So, they got rid of it. But the military never really saw silver as a strategic metal. And I think that's very important to understand.
But could that be changing though? Because there's all these new technologies that didn't exist in the 90s or in the 80s, the period that you're talking about. I was reading about these missiles that can change direction mid-flight that apparently need silver in order to function.
Yeah, it's funny, and there are people out there saying that these things use hundreds of ounces of silver per missile, and it's not true. We actually asked around, and the view is that the larger missiles might use 5 to 10 ounces of silver, and it comes down to like 40,000 ounces of silver in Tomahawk missiles in the entire existence of Tomahawk missiles over the last 20 some odd years. Smaller missiles use much less. It's mostly used in ignition batteries and in electronic contacts and connectors. But in the electronic connectors and contacts, and a lot of the stuff, for example, the guidable missiles that you're talking about, they prefer to use gold or platinum in those things because they have a higher reliability than silver. They don't tarnish. Silver is used in batteries for torpedoes, but those batteries they're not rechargeable, so they get recycled and on an ongoing basis. The use of silver is far less than a lot of people say, even in these strategic metals. It is important, but there are 5.5 billion ounces of silver floating around. And, that strategic stockpile, one of the reasons why we got this through Congress, and Senator McClure from Idaho actually introduced the legislation. He said that we're going to take the strategic stockpile that the military doesn't want, and we're going to convert it into Silver Eagles, which will be walking around in the pockets of Americans. And should we get into a crisis where the military needs that silver, patriotic Americans will turn in their silver coins. Now, I think real patriotic silver Americans would do that. There are a lot of people who claim they're patriots, but they're not. They're trying to overturn the Constitution and such. They'll hoard their silver, but there will be plenty of silver out there that can be turned in the same way we turned in tin and aluminum and copper during World War II. So I don't think that it's changing. Now, there are mining companies that are pushing governments to declare silver a strategic or a critical metal. And we've made the point that we think that's a mistake, because right now, silver is used in solar power, solar panels. It's used in a number of applications. It's a very dynamic industrial use pattern all through the industry. It's not a strategic metal. If silver is declared a strategic or critical metal by a government, that government then says, okay, how much silver exists in our country? Who's buying it and using it? Who's using it? Should we ration the amount of silver that can be used in mirrors or ball bearings or consumer electronic goods? Once you become a strategic or critical metal, you've got the government sticking their fingers all through the market. And not to sound like a rabid libertarian, but that's probably not a good thing for the silver market. And I would try to keep the silver market as far away from the government hands, regardless of which government you're talking about, as possible.
Do you think that the rise of easy access to gold ETFs through apps and zero fee trading platforms threatens silver demand? Because previously they called silver the poor man's gold.
Yeah.
But nowadays, poor men like me can just put $27 into a gold ETF instead of having to settle for, an ounce of silver, for example. So if you separate out the safe haven demand component and say, well, nowadays people can just get that, buying fractional amounts of gold on their smartphones, what's left for silver? Because, there's the growing demand in photovoltaic panels, but is that really any more exciting than, say, the lithium story in batteries or the platinum story in electrolyzers for green hydrogen?
I feel like I'm being set up with that question, because I think that silver use in solar panels is much more real than either platinum use in electrolyzers or lithium in batteries. But that's beside the point. One of the things that we're seeing with ETFs, I was talking earlier about how investors around the world are seeking to reduce the riskiness of their assets and the counterparty risk. And if you look at gold investment demand versus gold ETF demand, over the last 3.25 years, investors have been selling large amounts of gold ETFs, but they've been buying far larger amounts of physical gold. And what you're seeing with the gold ETFs are people not saying, I don't want to own gold. They're saying, I don't want the counterparty risk that comes with those ETFs. I want to own gold directly. And we don't have any numbers on it because it's all secretive. People don't publish this information. But there are any number of people and institutional investors who have sold gold ETFs over the last 3.25 years that have actually bought physical gold directly because they want that direct ownership. And in the gold market, you've seen this with the rise of ETFs. The people who invested in ETFs and gold, by and large, were not gold investors. They were gold equity investors, or they had never invested in gold. And here was an easy way to do it. I'm sitting at work. My friend sends me an email. He says, hey, the gold price is rising sharply. I'm buying some gold. I should do that. Okay, maybe I take off an hour or two at lunchtime and go find a gold bullion coin dealer and buy some gold. Or I can go to my brokerage account online and buy ETFs. And we saw this, for example, in the last 2 weeks. We saw a surge in ETF demand over the last 2 weeks of March. And that reflected short-term investors saying, hey, the gold price is rising sharply. I want to ride this horse, but this is the easiest way to quickly get right now, today, this minute exposure to gold price rises, not exposure to physical gold, exposure to gold price increases. So our expectation is that some of those ETF purchases over the last 2 or 3 weeks will now cycle out into physical gold when it happens. The nexus between gold and silver, gold ETFs and silver, is a little bit more spurious. And in the silver ETFs, when they were created, what we saw were people who had silver investments selling those silver investments and moving the assets into silver ETFs because they were easier to store, easier to buy and sell. And if you were owning a 1,000-ounce bar, say you had bought a 1,000-ounce bar at any point when the price of silver was $3.50 to $5.50 an ounce for like 15, 20 years, that was cool. Once the price went over $10,000, you sell that bar, it becomes a taxable, reportable object. So you don't sell that bar, you swap it for ETFs, or you swap it for silver coins. And you avoid the taxes, but now you have units that you can sell for less than $10,000, so they don't become taxable. So you've got a lot more moving parts in the silver ETF area and the physical silver area. I think that our take is that overall, the gold ETFs and silver ETFs have helped physical demand for gold and silver, partly because they have elevated the awareness of gold and silver on the part of investors. They have made it easier. Most of them actually do buy and hold gold and silver on an allocated basis. So they do represent part of that accretion of physical gold and silver on the part of investors worldwide. And they make it easier to do that. And so I think that, there may be some negative aspects of gold ETFs distracting dollars from physical silver, but I think that on balance, the existence of those ETFs have been beneficial for physical gold and silver ownership by investors.
You recently put out a video entitled "Why $50 Silver is Possible but Unsustainable." So could you give us sort of the Cliff Notes version? And I'm going to put your feet to the fire here and ask you, do you think you could tell us where you see silver's price going over the next 12 months? And then coming back to gold, where you see gold's price coming over the next 12 months?
Okay. So the first part was, why do I think that silver can rise to 50 but not stay there? And that's because silver is a tangible metal. It's a real metal. And if you look at the history of silver prices or gold prices, as we were talking earlier, the price can spike sharply higher. Silver got to $50 on an intraday basis in January of 1980. And in April of 1980, silver was the first commodity I ever found that lost half of its value in one day, going from like $32 to $16. It bounced back, but it lost half of its value in one day. The only time I've seen that before, later, was the oil market in April of 2020 during the pandemic and lockdown. And that was very specific to West Texas Intermediate Group. But, the silver price can spike higher. It got to $50 in 1980. It got to $50 in April of 2011. And if you look at what happened in April of 2011, that increased. Silver started April at $36 an ounce. And there was an enormous open positions. It wasn't one position. There were like 300 plus million ounces of open interest in the May COMEX contract. Over the course of April, anybody who was short May COMEX futures needed to either have the metal to deliver in May or buy those short positions back, close them out, or buy them back and sell forward into July. So you saw 370 million ounces of silver futures bought back in April of 2011. At the same time that happened, silver coin sales virtually dried up, and silver ETF investors were net sellers. The price of silver went from $36 to $49.90, virtually $50. We said this is a COMEX phenomenon related to the May roll. Once that May roll is over at the end of April, the price of silver is probably going to fall back to $36. We were wrong. It fell to 32 within 5 days, right? So the price of silver can be pushed higher by short-term investors in 1980 or by May COMEX future rolls or other short-term factors. But the silver market is, people ask, are gold and silver prices determined by the futures market or the physical market? And the answer is the long-term levels and trends in gold and silver prices are determined by the physical market. The futures market can determine and heavily influence short-term moves. On a long-term basis, there's 5.5 billion ounces of refined silver in above-ground inventories. Some people call them available stocks. We don't use that term, although challenged people in the silver blogosphere will say that we do. We talk about above-ground inventories. Probably available at some price, but that's beside the point. There are 5.5 billion ounces of refined bullion in above-ground inventories. In addition to that, you have more than 18 billion ounces of mineable reserves. And then you have vastly more silver in non-reserve resources yet to be mined, but at a higher price, that stuff comes out. Then you have about 23 million ounces of silver, that's 23 billion ounces of silver that's held in jewelry, silverware, decorative objects, religious statuary. There's a 1-ton silver, pure silver altar in Bolivia. I have a Ganesh statue that was given to me for a speech in Mumbai that is 10 ounces of sterling silver. And it's a statue. It's a statue of a god. And, you would think in the Catholic Church that would be a sacrilege to melt down. But in the Hindu religion, no. At $50, I'm going to melt that down. And it's not a sacrilege. It's good investment. So there's a lot of silver out there. The price of silver can go to $50. At $50, you have not 18 billion ounces of reserves, equivalent to more than 20 years worth of mining. You have probably 36 or 48 or 60 billion ounces of reserves because those resources become profitably mineable at $50. And everybody in the core silver market knows that. You also have a reflow of silver jewelry and decorative objects, and you have investors who say, I'm not waiting for $75 or $750 or $1,500 silver. $50, I'm out. So you see a surge of silver investment products, refined bullion, bars and coins coming back. You see silver decorative objects and jewelry coming back, needs to be refined. The refineries get backed up. It takes 2 or 3 or 6 months instead of 2 weeks to refine it because there's so much stuff that comes in. That's what happened in 1980. That's what happened in 2011. And that's what will happen again. So you can see the silver price on an intraday basis spike higher, same way you can see the gold price spike higher. But those spikes tend to last, well, in the gold market, the last spike lasted 20 minutes, and that was long. You can see that price, but on a long-term sustainable basis, you can't necessarily see it because there's so much silver. If this were something that has a truly limited supply, and it could be tantalum, a rare metal that's only mined in a couple places in the world, and by a handful of companies, or something that has a truly limited supply, then you can see a more sustained price. But silver has enormous above ground and in-ground reserves that are available that would come into the market at $50. Now, you asked about the prices.
I want to see the Ganesh statue if it's within reach. But
I'm
yes, the
sorry, I
prices.
keep that at home.
Ah, it's stored away safely.
There was a time when it was up there by my Maltese Falcon.
It sounds like quite a sight to behold. So yeah, what are your price forecasts then for silver and gold?
We're looking for record prices, further record prices in gold late this year into 2025. We're looking for much sharper increases in silver prices late this year into 2025, possibly into 2026. With gold on a, it'll sound ludicrous right now to those people who don't understand the difference between an intraday spike or a short-term spike and an annual average price. On an annual average price, we're looking for gold to average perhaps around $2,300 at some point over the next 2 years. Now, it's $2,350 or $2,345 as we speak. So that sounds bearish, but you have to understand that the average price of gold, we've set 4 records over the last 4 years on annual average prices. Last year, the annual average price was a record $1,950. So we're looking for much sharper prices. And again, if you're looking at an annual average 2,300, that doesn't tell you where the price could spike to, because in 1980, gold averaged $600 but it touched $850. In 1980, silver averaged $21, but it touched 50. So turning to silver, we're not looking for record prices necessarily. I wouldn't be surprised to see the price spike to $50. I think that would be later this year into next year. And that's going to depend very heavily, both gold and silver, on what happens politically and economically and in terms of financial markets on a global basis. I wouldn't be surprised to see silver spike as high as $50 on an unsustainable basis. And I wouldn't be surprised to see silver prices on an annual average basis approach where they were in 2011, 2012, which was probably around $34 an ounce, $35 an ounce. I think that you could get annual average prices that high. It's going to be hard because you have a lot of investors who bought silver in 2021 at $30 an ounce, and they have been waiting for the price to get back there to sell. Now you also have to deal with the psychology of investment. Somebody who bought because they listened to all that garbage about squeezing silver and running down the COMEX inventories and all that nonsense that was circulating at the time. And now they've been sitting with silver, trading between $20 and $25 until last week. And they say, if I see $30, I'm going to sell. But we know that some of those people, when they see $30, will sell. And some of them will say, well, let me see how high it goes before I sell. Yeah.
Going back to the Ganesh statue, if you did leave that out behind you, it could serve as some sort of indicator, couldn't it? Because it would mean once it was no longer there anymore, you'd melted it down and you saw
maybe that's why I don't keep it here. No, I don't keep it here because I'd rather have it at home than in my office. Yeah.
And just before we wrap up, I wanted to ask you, aside from gold and silver, are there any other commodities that you'd be bullish on right now?
Well, we are bullish on several commodities, but not necessarily for investors. I mean, gold and silver are quite unique compared to other metals and other commodities. But we like agricultural commodities. We think natural gas prices are probably at a cyclical low and could rise. Oil's probably fairly valued right now. Copper's a little bit overvalued. Copper prices have risen 10% in the last month. So, when people say, well, why are gold prices rising so much over the last month? So you have to put it into the context of the fact that there's been more than $1 billion that has gone into commodities indexed funds that get spread across commodities. We like some commodities like tantalum and high purity manganese, but they're not really suitable for investors. And there are a lot of commodities that we would tell investors don't get involved in.
So how does that work if you like the metal but it's not suitable for investors? What is it good for then in that case?
It's good for industrial use. So,
right.
you know, we work for, if you look at our clientele, where our revenue comes from, the biggest source of our revenue are investors, institutional investors, high net worth individuals, family offices, and companies that service retail investors. The second largest source of our revenue for us are mining companies. And then we have fabricators and refiners and smelters and central banks and governments and intergovernmental organizations and others that will buy our services. So we'll have companies that say, I have found a property that has cobalt in it. What do you think the cobalt price? Because we need an independent expert to talk to our banks and to talk to our potential shareholders and convince them that this is an attractive property that should be financed and developed. And, you know, we'll do that we do it on an opportunistic basis across commodities. So we've done agricultural commodities and cattle. We've done vanadium, tungsten, lithium, titanium, and then we do tantalum, niobium, molybdenum, and high purity manganese on an ongoing basis. And we do the base metals on an ongoing basis. And we provide our clients, we provide them our research, our data, unbiased data. We provide them our analysis, our price projections, and then we'll also help them with their investments and or hedging programs. So we will do asset management work. We will advise clients, investor clients, on how to manage their assets, commodities-oriented assets, but we'll also help them manage them, and we'll structure options-based investments. You asked a question earlier about do investors sell, to the effect of, do investors sell if you see $50? We have any number of investors who will sell at $50 silver, but we have a lot of investors who are savvy, who will keep their physical silver, but they'll buy put options at $50 or at $40. They'll buy them on a ladder scaling up. If you start seeing the price rise sharply, they'll start buying put options, and they may pay for them with call spreads. And we will structure and price and place those hedges for our clients, whether they're mining companies, smelters, refiners, industrial users, or investors. We will provide that kind of commodities management structuring service.
Right. So sort of a way to keep one foot in and one foot out without having to totally exit. Right. Well, yeah. Before we wrap up for today, I'd like to ask for your help with the Resource Talks $1 million portfolio. So the premise is simple. Each guest who comes on our show makes a single sell and buy decision of whatever value they wish. And we check in every episode to see how things are going. So on our last show, Sam Burns of Mill Street Research decided to put 100% of our $1 million dummy portfolio into the S&P 500. And today, on the 8th of April, so around 2 weeks after he made this call, our portfolio is down $2,500 or 0.26%. So Sam also told us that he'd sell 50% of the S&P 500 investment if we get to the 100-day moving average, and that he would then sell 100% if we drop below the 200-day moving average. So that was the sell decision rule that he left behind for us. So Jeff, I'm just going to share my screen a moment, and I want you to take a look at our plain vanilla portfolio, and tell me what would you do here? Would you leave it the same? So we've got $1 million, and we've got all of it in SPY right now. So
long SPY.
Yeah. So what would you do to this portfolio if you could make one decision? You can sell as much or as little as you want, and you can buy one thing with whatever you decide to sell.
See, at this point, I would probably be buying puts on the S&P and buying puts on gold.
Right. You can only do one of those things, though.
I can only do one.
Under the rules of the game, you can only
Okay,
make one
so
buy decision.
well, you said I could sell some of this.
Yeah, yeah,
So
you can sell some
if
of
you're
this.
down
Yeah.
to $997 in the S&P, I might sell $200,000 worth
Right. Okay.
and put that $200,000 into gold puts. I would look at August $2,100 puts. If I can do options.
Yeah. Okay. Sure. And what's your decision rule for us? So, how do we know when to get out of this position? It has to be a clear, sort of black or white type decision, so that it doesn't leave any
I
of
would
the
hold
responsibility
that.
on me.
I would sell those puts back if gold got to $2,175. All of them.
Sell those puts back if gold gets to, where did you say, sorry?
2,175.
2000, 2175. Okay, excellent. Well, thank you very much for your contribution to our model portfolio, and we'll check in on our next episode to see how things are ticking along. Once again, thank you so much for coming on the show. Could you please tell our listeners where they can go to keep up with you and your research?
So our website's cpmgroup.com. We have a YouTube channel, CPM Group, where we post videos pretty much every two times a week, Tuesdays and Fridays. And then you can send an email to info@cpmgroup.com. Our website will tell you all about the different services we offer. You can buy our reports, like our gold yearbook, which we released last month, our silver yearbook that we'll release in May. And you can see a lot of free reads and videos, including white paper reports on various aspects of gold and silver and platinum and palladium that we do for client companies to distribute to their clients.